markets. Let's understand what he is gathering in terms of the FI mood and momentum. He presents Kotak Institutional Equities. Pratik, good morning. Thank you for joining us. It's been a good comeback. It's been a solid comeback. Do you think this is as good as it gets for the year?
Good morning, Nikunj. I think it's too early to say if it gets as good as it gets for the year, because I think there are two main external drivers of our market. One is obviously the oil price, which, as you know, has come off very sharply in the last 1 week. Oil has come off even further by another 10%, now below $100. If you recall, back in June, we were about $125. So if oil continues to slide, that actually may pose some upside risk to the market. The second one is the outlook for the US Fed rate hikes and also global central banks rate cycle, which till somewhere middle of last week, it was looking like we're probably, inflation has peaked out. But the way that you might have seen the strong jobs report on Friday night, because of which, once again, the 75 bips rate hike for September is back on the table. And it's raised concerns about more rate hikes. That in turn means lower risk appetite, strong dollar, therefore lower inflows into EM markets. I think the issue is not so much about India-specific factors. I think that's not really a risk. It's more about global factors. But the one point I would agree with you is, in terms of when you asked whether it's as good as it gets, is the valuations for our market. India is still trading at a fairly expensive valuation of about 21 times, or rather, after the rally in the last couple of weeks, we have gone back to relatively expensive valuations of about 21 times FY23, about 18.5 times FY24. So it doesn't leave too much room for upside from here on, unless we see a pretty dramatic collapse in oil prices in particular.
Why are suddenly foreign institutional investors back? And when you speak to some of your clients and counterparts, do you think they are here to stay?
So firstly, I think when you look at if you look at the foreign flows, I think what we've seen in the last 4 to 5 weeks is really not driven by the active long-only flows in particular. A lot of that flow has come from the arbitrage funds and the hedge funds, and also who are covering their shorts on index futures, and also from passive flows. In fact, last 1 week in particular, we've seen typically a lot of foreign buying in the last half an hour of trading, which tends to be more index-driven, passive kind of flows. Active fund managers, they've also begun tiptoeing back, and partly that's been caused by the deteriorating outlook in China. So on a relative basis, incremental allocations to India are somewhat better versus, let's say, a month and a half back, partly also helped by the lower oil price. But we are seeing at the margin more and more investors looking at India, saying that the worst is over on a relative basis, especially compared to China, given where you have problems going on with the real estate sector over there, and now obviously with this geopolitical concerns. And as far as India is concerned, we've seen oil coming off, which was seen as a big risk. But once again, valuations are a bit expensive, so nobody's really rushing in. But selectively, we are seeing foreign investors beginning to get interested in India once again, looking to buy if the market comes off. But no one's really looking to rush and chase the market as things stand right now.
Good morning. This is Nayantara joining in on the conversation. So if you're talking about FI staging a comeback, wouldn't the corollary of that then be that the stocks which are battered by the FI sell-off will be the ones to make the first stage of comeback? I'm, of course, talking about the banking pack. Today, we're seeing SBI react to its earnings, but you're seeing also momentum shifting towards the mid-tier banks. Would love to get your take on banks and how you folks are approaching this pack.
Yes, we do believe that banks will do well, not just because of the foreigners sort of slowing down their selling or potentially likely to turn into net buying once again. And this was one sector, especially the private banks, which were hit quite hard because of the non-stop foreign selling we saw earlier part of this year. But I think even fundamentally, if you look at the earnings from most of the large private banks this quarter, they've been pretty good in terms of asset quality, in terms of loan growth, in terms of the net interest margins. So generally, the banks have performed well. And more importantly, from a valuation perspective, the private banks still look quite good compared to the outlook and compared to the past historical trading ranges for these banks. So as foreigners come back, as the outlook improves, given the better prospects for loan growth and NIMs, we think will not be as bad as the market is thinking in a rising interest rate environment. On the contrary, you may see the loan book repricing more aggressively for some banks. So in general, yes, banks is something which we think will do well, in particular the private banks. The state-owned banks, I think generally it was not really foreigner-driven. That was more because of macro concerns where these banks came off. And as those concerns ease, I think you will see those also beginning to perform well.
Okay, that's the word that's coming as far as the banking pack goes. Wanted to also ask you as far as the mid-tier banks go. If you were to break it up, you told us private versus public, but the price performance in the smaller banks of late has definitely been better. Bank of Baroda, Federal Bank, AU Small Finance Bank. Peaked out, or the best is yet to come?
No, we think for mid-tier banks, there is scope for further upside along with that of the private banks, the large cap private banks. The main reason is we think the worst of the asset quality issues are behind us. A lot of the credit costs are likely to come down, or the credit costs have probably peaked for most of these cases. And valuations are quite attractive, especially given the rally we've seen in some of the private banks last few weeks. So the valuation gap versus the large cap private banks has increased. So therefore, the mid-tier bank stocks still look attractive to us. We think that's one area which will do well. The only caveat over there is while there is potentially higher return over there, but there's also potentially higher risk in case the economic environment deteriorates, in case you have an oil price spike, in case the global outlook worsens and so on. But in general, we do like the mid-cap banks as well.
Pratik, wondering whether you're enthused about all the commentary that we are seeing now from new age tech companies, everything from a Zomato to a completely changed focus from them, or for that matter, even earnings from an Nykaa and Paytm over the weekend.
So I think what's changed is given the global increase in interest rates and tighter liquidity, and even in India, in the private markets, you've seen capital being less freely available, and we're seeing competition sort of winning. So that actually works to the listed players who've already raised capital, who are in a leadership position in the respective sectors. And therefore, you're seeing the commentary around greater focus on profitability and cutting the cash burn and so on. So that's a positive. For some of these stocks, I think in the short term, you do have to remain concerned about the potential technical factors like paper supply from pre-IPO locked up investors who may come out and sell. But that's frankly more of a near-term concern. The longer-term outlook will continue to depend on how these companies execute in their respective domains. And there we think some of these market leaders will do well, not everybody, and in some cases, business models are still suspect and yet to be proven. But some of the consumer-oriented names, we think there is potential for more upside. But bear in mind, while these are high return stories, potentially can give you high returns, but the risk is also quite high. So this is not for the investor with an average risk appetite. These are quite risky stocks still, given that they're not profitable as yet at the net profit level. There's a long way to go. Cash burn is still high, and competitive intensity could increase, going forward. So a lot of execution risk. But in general, yes, we've seen these companies sort of become a lot more focused on profitability and step up their investor communications in a couple of cases. So that helps.
Right. Pratik, wondering whether in the near term, all this excitement about Indians chasing SUVs and the auto divisions of most of the passenger car companies is already in the price while they continue to grapple with commodity costs not having fallen enough and supply side issues still persisting.
So on the auto sector, I think, unfortunately, one can't make a broad brush statement. Different segments have different drivers. But in general, our preference has been the commercial vehicle sector and the SUV sector. But obviously, there are no direct plays other than for commercial vehicles. But in general, the point we've been making is that over the last few years, this sector has been impacted by weaker demand or chip shortages, supply issues, and so on. That's the worst over there seems to be over. And on the positive side, the worst of the raw material price issues which these companies were facing in the last 6 to 12 months, that also is over. Now, going forward, however, I think it's an issue of valuation and also the earnings growth prospects, where we think earnings upgrades are likely to continue for some of these companies. In particular, we're more bullish on the commercial vehicle and SUV place. On the passenger vehicle side, we think some of the best of the upside in margins and in volumes is already priced in. Valuations are no longer attractive. So on a relative basis, we prefer the commercial vehicle and the SUV kind of companies and maybe some of the tractor companies. But in general, the auto sector was one sector which we had for the last about 2 years or so, we've been sort of cautious, but this year we've turned quite bullish and we still like it from a longer term perspective.
Sure. Pratik, great to have you on the show today. Thank you so much for taking the time out.
Thank you.
Okay.